Good morning, everyone. My name is Jonathan Levin. I'm a columnist with Bloomberg Opinion, and we are here for Jobs Day. We're going to get those payrolls numbers in just about 5 minutes. I am here with my colleague, Candace Zacharias, editor with Bloomberg Opinion, as well as Josh Hurt. He is a senior international economist with Vanguard. Here is your setup today. This Jobs Day finds the 3-month moving average of non-farm payrolls growth at its lowest in 3 years. The unemployment rate has been ticking up. It's moved up for the past 4 months. And some people are on high alert that we may trigger a little thing called the SOM rule, which has a pretty good track record historically of predicting whether or not we are in recession. Having said that, this is a very complicated labor market, sort of unlike anything we've ever seen before. Simple rule of thumbs sort of can't be counted on as they have in the past. Layoffs generally remain low, and all of this comes in a context in which markets have been selling off for a little bit, going through a little bit of a growth scare, and everybody is waiting to see when the Fed will take its first move in terms of cuts. So, Josh, welcome. Thank you very much for being with us. What does it all mean?
Yeah, thank you for having me. Great intro. It is a really important report today as well. We're expecting to see cooling but healthy labor market and job creation. So we're not expecting to see a number, above 200. We're expecting somewhere closer to around 150,000. Hurricane Beryl is definitely going to be something that the team will be looking for to see how much of an impact that has today. But we are expecting to see something a little bit softer than what we've been getting. So I think that's probably one thing to really keep an eye on. The unemployment rate is the other big one. It does serve as a great summary statistic of a lot of things going on in the labor market. We're actually expecting to see it probably tick back down to 4. And I would say, even if that weren't to happen today, that is our sort of medium run view here for the next couple of months, is we would be really surprised to see it actually tick up from here. So that's something as well. And then on the other key thing I think we'll be keeping an eye on will be average hourly earnings and just what is happening with the wage situation. We got some really good and important data this week on earnings from the employment cost index. It does show, that wages continue to move in the right direction. They're still healthy, but if you're the Fed or a policymaker, this is the direction you definitely want to see. So I think we should expect to see something along those lines today in just the monthly numbers. Consensus is around 0.3 as are we for this month. So we wouldn't expect to see anything materially different, but I will be watching to see if we get any impact from, again, Hurricane Beryl that could skew the numbers somewhat even higher if we do see maybe more of an impact to the labor market from that situation.
Okay. Yeah. Good. Important point on Beryl. We gotta be on high alert as to whether and if there is a Beryl impact. Is it noise? Is it confusing the way that we see the trend? Overall, the consensus here is that we'll get 175K on the non-farm payroll, and that the unemployment rate will sit there at 4.1%. Candace, with the 45 seconds we have left here until the number, does it feel like this one matters a lot more than your regular jobs Friday?
I think so. I mean, look at what's happening in the markets, but I think more importantly, remember what Powell said earlier this week, right? He characterized this job market as a gradual normalization of labor market conditions, but he warned that he would not like to see a material further cooling. And that's really what the market is going to be watching for. Has the unemployment rate, has the payroll number, is there a step change anywhere that would not only give the Fed a reason to start its easing cycle in September, but also, the big question around what is this easing cycle going to look like? And
Yeah,
there's the
and
number.
here we go. It comes in change in non-farm payrolls, 114K, well shy of that survey number of 175K. Looking at private specifically, the street was looking for 140K. You end up getting 97K. Now here is a big one. Your unemployment rate ticks up to 4.3% from 4.1%. Now, as Josh was saying, a lot of noise in a lot of the different components, but this is a very important summary statistic. And that is a meaningful move. If you were still concerned in any way, shape, or form about sort of wage price spiral dynamics, I think this report should also allay some of that. Average hourly earnings actually ticks down. The month-on-month pace, seasonally adjusted, is a 0.2%. The street had been expecting something a little bit higher than that. Now, this does come along with a slight uptick in labor force participation. So that's interesting. You're not looking at an uptick in unemployment that's going to be explained entirely by something deleterious like layoffs. Of course, initial claims had been ticking up, but relatively muted in the grand scheme of things. But really, I just want to come back to that unemployment rate at 4.3%. Remember, we've come a long way since the 3.5s we were talking about a year ago. Josh, what's your snap reaction to this number?
Yeah, not our expectations. So certainly coming in on the softer side, and very consistent with the messaging that we received on Wednesday from the Federal Reserve and Jay Powell. I think a couple things that really stand out. I was just mentioning, we were not expecting to see the unemployment rate tick up. So pretty big surprise to see that move up 0.2 there. Participation also, probably a driver there in terms of, and that's not actually too dissimilar from what we've been seeing. In that, our view has been a lot of the uptick has actually been supply related, rather than a substantial weakening of demand. So I'm surprised also just on the hourly earnings number to see that actually come in a bit soft as well, with a downside overall job creation number. I would have, said that had we seen something, along the lines of this 114, that would have been associated with actually higher average hourly earnings, with the potential that Hurricane Beryl had a larger impact on that. So the fact that we see some soft numbers in job creation as well as the soft wage numbers, to me really does jump out. And also, even so, looking at just net revisions, so we're overall, just subtracting from the overall numbers that we've seen. So a couple of really important areas for surprise, downside surprise, and very consistent. As I mentioned, with the messaging that we received on Wednesday from the Fed.
Yeah, sure. Candace, what are you seeing in the market reaction here? I'll actually I'll put up a screen, but I take it that the market risk assets aren't going to love this, but bonds sure will.
I mean, definitely not. The markets were already looking weak this morning. Futures have tumbled further after the news. The NASDAQ 100 now is down by more than 2%. So definitely, I think this is going to be a very weak day for markets. On the flip side, of course, we'll see bonds rally. The 2-year yield has tumbled about 29 basis points to the lowest in a year. And what else? We're also seeing a big move in terms of pricing for the Federal Reserve, which is not surprising, we now have about 42 basis points of cuts priced in for the September meeting. So that's about a 63% chance of a 50 basis point cut, or a half percentage point cut. And so I think, what markets are doing is they're looking at this data. They think it meets the bar in terms of a material cooling in the labor market. And they think what this is going to do is force the Fed's hand in September, not just to cut, but start with a bigger cut than one would have otherwise expected.
Okay. Yeah. Okay. So that's an interesting point that you bring up. Let's go there, because that's going to be the key question here going forward. Monetary policy wise, August is generally a quiet month, but we get a big opportunity for signaling when the chair and other members of the FOMC participate in the forum in Jackson Hole, Wyoming. There are, as Candace says, going to be increasing calls. Maybe there'll be outside calls, but there will be calls nevertheless for the Fed to go ahead and do 50 now in September. And there are going to be others, including some folks like myself, you might say, who might argue that the Fed kind of made a mistake by sitting on their hands at the meeting earlier this week. In light, of course, hindsight is a beautiful thing, Josh, here. But in light of this number, how are we thinking about monetary policy?
Yeah, I mean, I think all those things you said are certainly going to be, become a narrative today. It's markedly different from what our view has been going into this, and so that's the biggest area that I would see. And as I'm kind of looking through some of these numbers here, certainly on the softer side, even from the private, just under 100,000 overall on private. I'm not seeing any major sectoral, areas to be of great concern about, other than just overall, cooling across a lot of these categories. In some ways we got a bit of a response from Powell on Wednesday about the 50 basis points. That was something they were not actively considering. And again, my initial reaction is that the uptick in participation that we're continuing to see, whether that is, we've been really focused on, the 16 to 24 age group category has been an area where we've actually seen a lot of volatility and some, very increased supply recently, as well as the immigration front. My immediate reaction is that as we will look through these numbers, that could be something driving rather than out and out weakness. But you don't really want to discount either that the unemployment rate rising to that extent. And it is now above where, at least in the most recent projections from the Fed, they would sort of have the natural rate of unemployment being at 4.2. So we've ticked above that, and so very consistent messaging with what you would have expected from Wednesday. I mentioned we were expecting a lot more neutrality in the FOMC communication and specifically in the press conference communication. Immediately this starts to feel a lot more appropriate given what we're just seeing from, this data this morning. Really big move. Also just calling out the move in the 10-year, so we're down almost 40 basis points just in the last few days, just this week. So pretty big moves.
Yeah. Well, you mentioned the 10-year. I'll go ahead and put it up here on the screen. Well, here is your daily chart. As you say, massive move. If you just look back a few weeks, and if you look back a few months, there has been a meaningful loosening of financial conditions in practice as a result of what's going on in the 10-year. Now, Candace, I did want to come back to the Sahm rule, because so it is a very fascinating empirical regularity that a lot of folks in markets have really zeroed in on. We are triggering the SOM rule with this move up in unemployment today. What the SOM rule essentially says is if you see the 3-month moving average of U3 unemployment move up 50 basis points from its low in the previous 12 months, then you are probably already in a recession. And again, it's not a hard and fast rule. It's not a law of the universe, but it's an empirical regularity, which has tended to be correct in other cycles. History doesn't repeat itself. It rhymes, yada, yada. Should I be freaking out right now? Is it all over for this U.S. economy because we have triggered the SAM rule, Candace?
Claudia Sam is a Bloomberg opinion columnist, and she's written in the past that the indicator that she developed, like you said, it's not a rule. It doesn't have to happen, but it does tell you what has happened in the past. And since the 1970s, the SOM rule would have been a reliable indicator of a recession.
Mm-hmm.
Does that mean it's going to happen now? Well, we're in a very, very different economy after the pandemic than anything really that we've seen before. And Claudia herself has said that triggering the SOM rule may not indicate a recession this time around. Right. Does that mean that we ignore it? I don't think it means that we ignore it either, because as Josh just mentioned, we've had, different things happening in this economy. The labor market has expanded. Remote work has brought more women into the workforce. It's brought more people with disabilities into the workforce. We have seen greater and higher levels of immigration. All of these things have helped to rebalance the labor market, but our labor supply still perhaps needs to catch up. And so, that's the sort of benign interpretation of what's going on here, that yes, the unemployment rate has risen, the SOM rule has been triggered, but it's not the end of the world yet. But I think what the takeaway still needs to be, from a policymaking perspective, that once the SOM rule triggers, one can expect that we're going to see a sort of negative feedback loop develop, and that we might see the unemployment rate continue to rise from here. We might see an acceleration in layoffs. And that's really something that the Federal Reserve needs to be focused on, to get in there and provide the monetary policy cushion before some of those negative economic events start to get more sort of entrenched.
Yeah, I worry a little bit about the pace of the weakening of this labor market. I think, if you're clearly seeing a gradual weakening in the labor market, you say, well, it's okay to be on hold and waiting until late September. But when I see this big of a drop off in the number versus expectations, it's reasonable to ask yourself, okay, well, where are we going to be the next time the Fed gets a shot at this in late September? I do want to put up the decomposition of the non-farm payrolls number. I always find that helpful because, month to month, different things can happen. It can push around the number for idiosyncratic reasons that maybe don't tell us that much about the macro. So let's go there. Let's dig in. This is our breakdown of U.S. non-farm payrolls month-on-month net change from the ECAN screen on the Bloomberg terminal. Again, you're looking at those 114,000 jobs created. Where are they coming from? Construction still adding jobs to the tune of 25,000. I find that interesting. I mean, over the course of this morning, we're going to have to dig further under the hood of that. But construction is one of these things that you expect to be highly rate sensitive, very cyclical. Construction employment is sort of one of the key ways that monetary policy works traditionally, and again, this is an atraditional cycle, but construction employment still kind of humming. Manufacturing, nothing doing there. Trade, transportation, and utilities still adding jobs. Information, you see a big red number there. I don't know if you all can see my actual table, but that's a negative 20,000 for information. I find that pretty interesting alongside the negative 4,000 in financial activities. A key theme in this labor market has been more softness, I think, in the sort of white collar space than elsewhere in the labor market. And you see that continuing, maybe even accelerating a little bit. Also, professional and business services. That's another area that I broadly file under, like white collar jobs, slightly higher paying jobs. And you see it. Job growth basically flat there. It's a negative 1,000 in the in the table. Also, some declining jobs in other services. It's a mixed picture here. What do you see in this decomposition, Josh? Is there any clear narrative in it to you?
I think you hit on really the areas that we were going to be focused on as well. The white collar recession narrative is something we've definitely been keeping an eye on, and there was nothing in this report to really move us away from continuing to see some of that softness. You're right that the 20,000 in information, can be a volatile sector at times.
Mm-hmm.
But certainly a big number, and again, very muted professional and business services activity. The other thing that we were really watching was just the leisure and hospitality sector, just to get a sense. We thought this would have been one of your key areas if Hurricane Beryl had a bigger impact.
Mm-hmm.
It doesn't appear that there really was a material impact. And even just looking on, the BLS release, they actually have a note that they are not attributing a significant impact from the hurricane to these numbers. There wasn't anything abnormal about the response rates as well, et cetera. So I think that's an interesting area overall. Fully agree with you on sort of the construction and manufacturing side. Construction has been an area that we've actually been holding up as one of these areas that is, pointing to how the economy is weathering the rate environment. We've continued
Mm-hmm.
to see, really good, construction and building numbers. Even so on the single family construction numbers. So looking at the residential housing market, an area we would say is certainly one of your most rate sensitive. And really continuing to see healthy numbers, across that area is pretty consistent with that. So I think those are some of the really key things that we're seeing here. Just overall, a couple of sectors that we're seeing the muted growth overall, and that's what brings us down to probably a number that is below the replacement rate today.
Right.
If we think it's probably somewhere in the maybe 150,000 or so. It's depending on what we're seeing on immigration and such. We're probably below that in today's numbers. The only other thing I would just call out is just some of the reason for unemployment. So you saw a big tick up in actually unemployed. A lot of those also were coming from folks who were on temporary assignments. So you might think of this as, summer jobs, summer work. So 314,000 coming off of those types of jobs. So that was a relatively big category, rather expected this time of year as we're transitioning from the summer months into the fall. But yeah, I think that's well said on sort of the key themes here.
Yeah. Okay. And I did want to put this this decomposition up for a sec once again, because one thing that I think is always important to do. You got a lot of noise in these numbers. You get a lot of revisions, and it's always useful to sort of look at it as a sort of rolling 3 months. And if we do that, I can paint a slightly more optimistic picture. You're looking at a little bit north of 500,000 jobs created in the rolling past 3 months, and versus the rolling 3 months before that. I think that's actually, I mean, it's basically a flattening. It's not a continuing of the trend. So, if I'm looking for shards of hope in this number, I could say, based on the rolling 3 month average, it's not that. Maybe the deterioration isn't as fast as one would be inclined to think. And the other piece that I wanted to just dig into real fast for people, because you mentioned it, was the leisure and hospitality piece. A lot of questions around Hurricane Beryl that hit Texas during the survey period, of course. And you point out the note from the Bureau of Labor Statistics, and indeed, kind of a non-issue here. I've drilled into the leisure and hospitality data here. Accommodation and food service actually adding quite a few jobs in the light red bar there, and then in the deeper red bar, arts, entertainment, and recreation. You actually see a bit of job loss, but it's such small numbers that you wouldn't attribute too much to it. I did also want to put up here. We usually focus on U3, which is the headline unemployment number, which includes a lot of stuff, and if you're using that as your gauge of whether or not the economy is quickly deteriorating, it can be complicated in a funky labor market like this one. Always nice to do a gut check over with U2, which is your job losers and persons who completed temporary jobs as a percent of the labor force. U2 here ticking up fairly meaningfully to a 2.1% from a 1.9%. So there is some legit job loss in driving this number, and those are the kind of dynamics that we that really sort of send our antennas up as Somm rule watchers in all of this. Let's see, just a couple of minutes to go here. Let me come back to this idea of what we've been calling the big stay, Josh. Up until now, this economy, this labor market, has been not terribly bad. Not a lot of people losing their jobs. But the problem was that the labor market sort of seemed to be stuck, right? That's why we say we sort of moved from the Great Resignation to the big stay. Guy Berger, a great economist over at the Burning Glass Institute, has also written a great bit and quite eloquently about this framing. So people on the outside of the labor market, say those recent college graduates that you yourself mentioned earlier in this conversation, Josh, having a pretty hard time getting into the labor market, even if not a lot of people were getting fired. How do you think this shakes out? How does that situation resolve itself here? And do you think that needs to get worse before it gets better?
Well, you're exactly right. This is an area we've been watching really closely. I mean, and it does point to the cooling in the labor market. There's no question that we have moderated. The theme that you've been hearing from the Fed is that the labor market is coming into better balance. We would certainly agree with that characterization. I mean, it does feel to us to be much more about normalization than weakening. And this is something that we would say is very typical of a labor market that is cooling in its early stages. You tend to find that the rate of hiring just slows modestly and isn't able to support either the new entrants or the re-entrants to the labor force in the same way that it was when things were really moving. In the recent environment, that might be the last, say, 24 months or so, where you had really significant job demand out there, and there was no problem really keeping up with any of the entrants or the supply that was increasing. Now we're getting into that phase where you are starting to see that become more difficult, and that's where we're seeing it most acutely is those that are coming in from college or those that are re-entering the labor force. They're just having a more difficult time finding employment. We are not seeing anything material in the layoff front yet. And that's not exactly, at least historically, wouldn't be one of your key drivers of unemployment rate increases. You tend to see that is very volatile. And the more meaningful contribution to a rising unemployment, at least in the early stages, is this rate of hiring just slows, modestly, not enough to keep up with your entrants. So that's really important. I mean, we have been keeping an eye on the layoff rate, and it's very low. We're probably running at a rate that is around 200,000 per month below what is kind of maybe a recent normal level, something just under 2 million every month. And so we're still running well below that. And we are seeing that people are staying. The quits rate has definitely fallen, and so this is definitely that kind of a dynamic. This is a lot about normalization for us. So we're not seeing any material signs of weakening or stress. And when we cover corporate earnings and we look at margins, we still see that those are, for the most part, very healthy. So I think that's where we have been, framing this labor market currently. I don't think there's anything in today's report that necessarily changes that, but it is worth a second look. When you see the unemployment rate tick up as much as it has, and just what we're seeing in the overall numbers. So additional scrutiny is certainly worthwhile here.
Yes, absolutely, absolutely. Candace, I'm going to give you the last word here. Josh brings up a very important debate. Runaway, snowballing deterioration in the labor market or normalization, right? That is going to be the big question that we're all going to be mulling over for the next month and probably the next 6 weeks until our policymakers on the FOMC get a chance to do anything about this here. Similar to what Josh is saying here, Ernie Tedeschi over at Yale's Budget Lab has suggested that we really need to distinguish between a labor market hitting a ceiling with diminishing returns rather than a recessionary dynamic. The point being, economists like to talk about this concept of full employment, right? It has sort of different names, slightly different concepts. People talk about NAIRU, but the idea is there's a sort of steady state for unemployment in the U.S. economy, and some people, maybe a lot of people, think that we've actually been operating below that long run steady state, and so it's natural for us to slowly back into where we should be or where we can be on a sustainable basis. And it's very hard to estimate this number. There are estimates in the Fed's summary of economic projections that you might use, and we are right around there right now. The Congressional Budget Office has their own estimates. They're a little bit higher, but what do you make of this debate, given what we know now? Are we normalizing, or are we looking at a runaway train?
John, I'm going to quote you here and say, don't take 1 month's number as the whole truth. I think we'll need to see more evidence of a deterioration in the job market before we can answer that question entirely. But I think another way of asking this question about, what is the natural or neutral unemployment rate is what we're seeing right now a benign rise in unemployment caused by an expanding labor force, even as payroll growth, stays reasonably healthy, but it still needs to catch up to that expanding labor force, or is it something more worrying? And honestly, there's a lot of mixed signals out there. We still have very low levels of layoffs. What does that tell you? We have a very high participation rate. This is not a good payroll report, but as you said, if you look at the 3-month average, we're kind of just holding steady. And so that would kind of argue for us hitting some kind of, employment ceiling, a full employment ceiling. On the other hand, we know that labor market conditions can deteriorate really quickly. And there are some worrying signs out there. We've seen a tick up in initial jobless claims data recently. Bloomberg Economics has pointed to something called a worker adjustment and retraining notification data. And that's just, data from large employers that are about to announce layoffs. They file certain notifications with the state labor departments. And if you dig into that data, according to Bloomberg Economics, what it points to is sort of the layoffs widening out from the technology sector, from California into other Sunbelt states and into other sectors. So, you could argue that there are some worrying signs under the hood. And really, what the Fed needs to do is get ahead of that. Paul Krugman, in a recent article, called this a pre-recessionary market. And if it's pre-recessionary, what the Federal Reserve really needs to do is preserve the expansion, preserve the health of the job market. And we don't have to agree necessarily at this point of time how to categorize the rise in unemployment. But I think we can all agree that the Fed has room to bring in that soft landing that people like to talk about. And now would be the time to do it.
Right. Yeah. And also to summarize, a lot of uncertainty coming out of this number, but I think on balance, you have to come away from this saying the risks have tilted a little bit more toward the full employment side of the Federal Reserve's mandate after this morning's number. I want to wrap it up right there. Your non-farm payrolls increase in the United States of America for the month of July was 114,000. Again, significantly weaker than the 175,000 that the street had been expecting, and the 206,000 the previous month. On the back of that, you saw a big move in treasuries. To give you the market move, you're looking at a yield on your 10-year treasury of 3.85%. Not only have we broken below that 4% threshold as we did earlier this week, but we are now well below it. I want to thank Candace Zacharias, my editor with Bloomberg Opinion, Josh Hurt, senior international economist with Vanguard. Thank you to everybody for joining us. We do this for all the big macro releases and Fed days, so please come back and join us again.